Welcome everyone to a very special event. I'm Amy Smith. Many of you might know me from the How to Make Money in Stocks Investing show that I do with Matt Galgani. First, we're going to hear from our sponsor, John Carter from Simpler Options, and he's going to talk about using options to swing trade growth stocks. And then we'll go into today's topic, which is 7 selling strategies to protect and maximize gains, followed by some selling animations with Mike and Charles, and then we'll finish up with a Q&A. So I want to introduce our sponsor first, John Carter. Welcome to the webinar.
Great, Amy. Thank you very much. As always, it's always a pleasure to do anything with Investors Business Daily, and I always like listening to Mike and Chuck and seeing what's going on. I cut my teeth in learning about stocks in the early 90s, going to live seminars with William O'Neill and learning that entire process. So I've been a fan of Investors Business Daily pretty much since day one of my investing career. We can go to the next slide. And what I have done, or at least my niche, has been options. And what I do is I take all of the knowledge and all the amazing fundamental data that's available in Investors Business Daily, and I take that and then I marry it to specific technical indicators in the options market. And I've written about this. This is a book that I wrote called Mastering the Trade. This came out in 2005, updated edition in 2012, and a lot of the stuff that I do can be found in there. Next slide. And at the end of the day, what's interesting is that when you're, there's two schools of thought. If you like a stock, buy the stock and hold on to that stock as long as it's going to go. And what I love about Investors Business Daily and the methodology is the goal is trying to hold a stock during that sweet spot. Today I wouldn't buy Microsoft. It's not a stock that interests me, but for a period of time, it was a great stock. It was going through that high growth phase, and that was a stock that, because of Investors Business Daily, it was like, all right, great, this is something that we want to be in. And these days, it's kind of the same thing. There's a lot of stocks out there that you hear about that don't necessarily make great, what I would call more kind of those explosive potential investments where a company's in the process of going from, say, a market cap of $3 billion to $10 billion. Well, in those kind of sweet spots, options are a fairly fantastic instrument to take advantage of that. And it really just kind of comes down to timing. And the questions are, how do you trade options on growth stocks? A lot of times people get the direction right of a stock, but they lose money on the options because they don't really understand how options work. What are the best swing trading setups to use when timing options? And what technical indicators should you use? What are the foundational analysis techniques that you should use with options? What are the criteria to look for when choosing a stock to swing trade? And when all that kind of comes together, then this makes a lot of sense. And we can go to the next slide. So at the end of the day, this is what I do. I have essentially spent the last 2 decades marrying my technical approach to trading options specifically with Investors Business Daily related growth stocks. And what I've done with this is put together a class, and for those of you that are interested in kind of diving into this and going, all right, I can take the same strategies that I'm learning at IBD and apply options to it, that's what this class is all about. So I've been doing this for 20 years. I think growth stocks offer the greatest options trading opportunities in the market today, as long as you know what you're doing. This is a 4-hour class that I recorded that shows exactly what I do. It's actually listed on our site for $497, but just kind of as a, hey, you guys are with Investors Business Daily, and this is just kind of an offer for you guys. You can get it for $7, and you can learn all this stuff. If you just go to simpleroptions.com/swing trading, that offer will be up for the next 24 hours. I encourage you to take advantage of it, and if you don't like, if you didn't feel like it was $7 worth of information, you can send it back. All right. That's all I got. I'm looking forward to listening to the webinar, and I will turn it back over to you, Amy.
Okay, great. Well, thank you, John, for joining us. It is my pleasure now to introduce 2 of my favorite guys. We have with us here, we have Mike Webster and Charles Harris. They are portfolio managers for William O'Neill. They've been with Bill for about 20 years. They taught at a lot of the workshops. I've had the pleasure of hearing them at several level 4 workshops, which is our highest level, as well as chart school. So Mike and Charles, welcome to the webinar.
Oh, thanks, Amy. This is Mike, and we're both really happy to be here.
Yeah, thanks, Amy. Welcome, everybody, to the webinar. I'm Charles Harris, and I'm going to start us off by covering a number of technical sell signals that often occur when a stock is forming a top. And after I've gone through these 7 signals, I'm going to bring Mike and Amy back into the discussion, and we'll go through a couple of topping animations where we'll follow a stock on a day-by-day basis, and we'll describe how we would scale out of the stock based on the topping signals that I just covered. Now keep in mind that the sell signals that we're going to talk about are just a subset of a larger group of signals that we cover in some of our workshops. Now before we get started, I should say that most investors find that selling is much more difficult than buying. It's pretty clear to determine where the proper buy point is when a stock is breaking out of a base, but it's often not so obvious when it comes to selling a stock. But there are a number of indications and signposts that we've identified through our studies that typically occur when a stock is topping. So if you can recognize these signals and act on them, then you have a fair chance of exiting a position before the stock breaks down too badly and is far off its peak. Now, when we make a decision to buy a stock, we're always focusing on both the fundamentals and the technicals. But when it comes to selling, we're going to act on the technicals only, because most of the time a stock will peak and begin trending lower well before the fundamentals break down. So the chart is usually your best and earliest indicator that a stock might be topping. Now most of the time a stock will flash a number of technical warning signs when it's in the process of topping. So one signal alone typically won't be enough information to exit your entire position. But as the evidence mounts and you see more clues, you should act on them by scaling out of your position as it becomes more apparent that the stock may be topping. So our goal isn't necessarily to try to get out at the high. We don't pretend that we're going to be able to top tick the stock, but rather our goal is to get out as we recognize the warning signs and technical sell signals that often coincide with the top. So if you can manage to average out of a stock within 10% or so of its high, then you're doing really, really well. So let's begin with the first sell signal, and this is when a stock goes into new high ground on low volume. If a stock goes into new high ground on noticeably lighter than average volume, or volume that's clearly lighter than previous moves to new highs, then it's a clue that institutions aren't running the stock up. And since institutions dominate the market and are the driving force behind big stock moves, that lack of volume is indicating a lack of institutional involvement, and so that rally is suspect. So it's really important that the price action be confirmed by the volume action at these important points when a stock is clearing resistance and moving to new highs. So let's take a look at an example. This is HollyCorp, and now we're going back to 2007, and you can see the stock broke out of a cup with handle base, and then staged a really nice advance over the next 5 or 6 months. Now, we can see here that as the stock was moving into new high ground, look at the volume. Well below average as you're going into new high ground here. Now, by comparison, look at the volume when it was going into new high ground over here in the chart. You can see the heavy volume over here on 1, 2, 3 days moving into new highs. Even over here as you're moving into new highs, you see the large volume bars. But here is conspicuously low. So what we're going to do is sell into that, scale out of our position as the stock is moving into new high ground on that light volume, because that's our indicator that we don't have institutional support there. Now again, we're going to scale out. I'm not going to suggest that you would dump your whole position because of this kind of action, because you never know what's going to happen. We didn't know the stock was going to roll over so badly after this kind of low volume highs here, but it can happen. So perhaps you would scale out 10, 15%, maybe 20% of your position as you see this kind of action. The beauty of it is you're selling it offensively into new highs as opposed to waiting till the stock breaks down badly. So that's the new highs on low volume. Let's move on to the next one. So this is when a stock has a weak rebound rally, and typically this will be off of a moving average or other area of support. Now, healthy price and volume action occurs when a stock is advancing on relatively heavy volume but pulls back on relatively lighter volume. So this type of price and volume action is indicating that the stock is under accumulation. But if the reverse happens, such that the stock moves down on heavy volume and then begins to move up on lighter volume, then it's suggesting that the stock is under distribution. So that would be a warning sign. If you see this kind of action occur, you want to sell at least some of your shares into this strength on the way up, because the presumption is that this low rebound on the downside. So again, this is an offensive way, selling into strength to get out of your part of your position. Let's take a look at an example. This is a stock called Thomas & Betts. You can see in the lower left of your screen, the stock formed a double bottom base and then staged a huge gap up here, well above the pivot point, which was around 35, and had a really nice long advance, more nearly doubling, maybe going up about 80% from the mid-30s up to $61. And you can see here, I'm going to zoom in on the top. The stock comes down to the 50-day moving average here. And you can see we've got 1, 2, 3, 4, 5, about 5 days of heavy volume or above average volume on the way down to the 50. Now volume on the way back up, you had a couple of above average or heavier volume days, but in comparison to how the stock came down toward the 50, this was a relatively lighter volume bounce toward new highs. So as you notice that this volume isn't what you'd like to see, in fact you can also compare it to volume a little further to the left here. When you're coming off the 50-day down here, you see volume really beginning to pick up and really getting heavy as you're moving to new highs. Here it's just much lower than that, again lower than how you came down to the 50. And you can see that the stock resolved by, again, falling, and look at how the volume picked up as you began to move back down. So again, here's your weak rebound rally, and you can sell into that as you recognize that volume really isn't as heavy as you'd like to see it. So let's move on to the next sell signal, and this is when a stock breaks below the 50-day moving average in a decisive way. And this has always been one of my favorite sell indicators, because the 50-day moving average line will sometimes contain a stock's entire advance right to the very top of the move. So if you've got the right stock and you have the patience and the discipline to stick with it until that 50-day moving average is decisively broken, then you may be able to ride out the stock for a really huge gain. Now, when stocks are in uptrends, the 50-day moving average line will often act as an area of support, because institutions like to buy on pullbacks in order to keep their average costs low. You have to remember that big institutions have many, many billions of dollars to deploy. They can't always buy stocks when they're moving up because they'll run their average costs too high. So they take advantage of pullbacks and weakness in order to add to their positions, and that 50-day moving average is typically one of those areas where they step up to the plate and support their stocks. Sometimes a stock will break below the 50-day moving average in a relatively minor way for just 1 or 2 days before coming back above. So we call that a shakeout because it scares a lot of people out of the stock. It can be very scary when you break below that 50-day. Now, if the stock does not find support at the 50-day, but rather decisively breaks below it, particularly if it's on heavy volume, then that is a very serious warning sign. And this is especially the case if the stock found support at the 50-day on previous pullbacks. So this kind of action would suggest that the uptrend may be broken. Now, by the time the stock breaks the 50-day, you're likely going to see a number of other warning signs that have already occurred. So typically, this can be a very negative sign. So I would probably be exiting the remainder of my position on this sell signal. So let's take a look at an example. This is Travelzoo. This is going back about 10 years, a little over 10 years. And Travelzoo had a gigantic move. It started out at 10. I'm not sure if this stock had a split along the way, so I'm not sure about that, but it broke out around 10 and went up to nearly 111. So it's like an 11-fold move. So it's a gigantic move. But look at the 50-day moving average. That's the red line on your chart, and it contained the entire advance all the way to the top. So it held at the 50-day here on one occasion, 2, 3, 4, 5, 6 times. And then finally over here, kind of focus on that, right up here, you can see how weak the stock is on this day. You decisively close below that line, and that's it. The stock is topped, and it went much, much lower from that point on. So if this was your only rule, that the only thing that you were really focusing on, you could have held the stock all the way up for a 10, 11-fold move, and finally you would be exiting the stock up here in the high 80s.
So Charles or Mike, how much would you be selling here?
I would be completely
out
of the stock
Okay.
here. This is a very ominous sign, given that the stock is held on 6 other occasions at the 50-day.
Yeah, and I totally agree with that, Chuck, that also the fact that it had a base that it broke out and was failing from there is, another sign that this stock is really, it's already had its day, and along with what Charles is going over, that break of the 50-day, combine both of those, there's no reason to be in that stock after that.
Yeah. And Bill would say, it's up 10 or 11 full. What more do you want?
What more do you want?
Yeah.
Right.
So let's move on to the next one. And this is when a stock has its largest one-day point loss since the very beginning of the move. And this is especially the case if that large one-day drop occurs on heavy volume, because that's going to suggest that institutions are behind the selling. Sometimes you'll see this large drop occur on a gap down, so it'll look, very, very worrisome or severe on a gap down. Now, we're not going to suggest that you sell your entire position simply because your stock has one really bad day. But at the very least, it should put you on guard and maybe put you on the defensive, because sometimes that first really bad day is just the beginning of a much larger decline. Let's take a look at what that might look like. This is Wesco International, and again, at the lower left of your chart, you can see a cup with handle base. And the stock had a huge move, more than doubling over the next 7 or 8 months. And finally, just a few days off the top here, the stock has its largest one-day point drop of the entire move, going all the way back to the initial breakout down here. You can see the volume on that day was very heavy. In fact, go back up here, that's the heaviest volume since the stock broke out, the heaviest down volume. So that's your largest one-day point drop. You would begin to scale out here, because sometimes this kind of action just leads to a much further drop, which is exactly what happened. It got hardly any lift all the way down. And in fact, the next day after this large one-day drop, you had another bad day on a gap down. You did temporarily hold at the 50-day moving average, and then finally decisively break below it. So again, you're going to see a number of sell signals when a stock is putting in a top. Your goal is to scale out as you recognize these warning signs. Let's move on to the next one. This is when a stock has a downside reversal day. Now, a downside reversal occurs when a stock hits a new intraday high, or is attempting to make a new high, but ends up reversing all of those gains and closes down for the day, closing near the bottom of the day's trading range. Now, often this occurs on a pickup in volume, but it's not always the case. So when we look at downside reversals, we're really focusing more on the price action. It does not have to be accompanied by heavy volume. Now, a downside reversal is not an uncommon occurrence. You will see sometimes many downside reversals in the context of a long move, long uptrend in a stock. So it doesn't necessarily mean that an ultimate peak has been put in place, but what a downside reversal typically leads to is further weakness in the short term. So, that's very important information to have, because it's very important that you have an expectation of what is normal and what you can expect from your stocks. So if you see a downside reversal, you can prepare yourself for maybe another 2, 3, 4, 5 days of weakness where your stock may come in 10, 15, 20%. If you don't have an expectation that that's going to happen, then you might capitulate or get scared out of the stock right at when it's at its lows. So even if you decide that you're going to hold through this kind of action, at least you can psychologically, emotionally prepare yourself for what may be about to occur. So let's take a look at the downside reversal. This is a Novell. Again, stock broke out of a cup with handle base, staged a huge advance, more than doubled. Now, fairly early in the move, within the first, 7, 8 weeks, you get this downside reversal right over here, and obviously that did not lead to that was obviously not the ultimate peak, but you got what you would expect, about 5 or 6 days of further selling, and then the stock resumed its uptrend. So that's normal action, what you typically see after a downside reversal. If we move to the closer to the top here and focus on that, you can see a downside reversal right here on this peak day. So you went into new high ground on an intraday basis, closed right at the bottom of the range. In this case, you did have a pickup in volume. Your expectation is that you're going to get further weakness from this point, at least for several days. Now in this case, you only got one more day of weakness on an intraday basis, and the stock reversed back up, actually staged what we call an upside reversal. And our expectation after an upside reversal is that the stock will continue to move up, which is what happened over about a 2-week period. And then you can see right up here where my little pointer is, you get another downside reversal as the stock is attempting to get to new high ground. You close near the bottom of the range, and then you continue to fall from that point. 1, 2, 3 more days down to the 50. You stage a relatively weak rebound rally over the next, 6 or so weeks, 6 or 7 weeks. You can see that the volume really wasn't much to speak of as the stock was trying to rally back, and finally you roll over again. So that is your downside reversal. Let's move on to the last 2 technical sell signals that we're going to present today. And these are what we call churning and stalling action. And these are both forms of distribution. And in the past, I've always really used churning and stalling kind of interchangeably. But for purposes of this webinar, I'm going to differentiate between them. Churning is defined as heavy volume without further upside price progress. So you'll typically see this kind of action occur after a stock has already had a big move and is near new highs. And at these new highs, you will see that volume will remain heavy, but the stock will struggle to move up further. Often you'll see the stock close in the lower part of the day's trading range. So what this churning action is suggesting is that the stock has already been played by the smart money, and at these elevated levels there's more than enough sellers to soak up demand from new buyers. Really, it's going to look like the stock is running in place with heavy volume occurring. Now, sometimes, another way we can describe churning is it's a process. You can identify churning on a single day, but you can also identify it over a number of days or even weeks, where the stock will be trading in a relatively tight range near its highs, and volume remain heavy during this process. Oftentimes, when you see this churning process, you see downside reversals occur, you see stalling days occur, and so forth. So that's what churning is, heavy volume without upside price progress. When I talk about stalling, I'm going to focus more on just the price action. It doesn't have to occur in heavy volume. So stalling would occur when a stock moves into new high ground, but closes well off the highs. So it's going to look like a weak action, excuse me, like weak action on a daily basis, even if the volume wasn't that heavy. Let's take a look at what churning and stalling looks like. Now this is a stock called GGB. It's a symbol. The stock broke out of this consolidation here. It's a little bit of a sloppy consolidation. It broke out and then consolidated again, forming, you might want to call it a flat base or a square box, kind of on top of this area here, and then finally staged the advance up here. Now, during this whole process up here, we're talking, let's say, 1, 2, 3, about 4 weeks. The stock is trading, very close to its highs, within a few percent of its highs. Volume is remaining quite heavy during most of that time period, and this whole process is what we call a churning process. You've got, enough sellers here to soak up demand from new buyers, so the stock can't make any progress, even though the volume is still heavy. You can see if we focus here on this little area, we get a downside reversal here at the peak. You come down, bounce up, attempt to go into new highs again, and again you get a downside reversal, which led to further selling for a few more days. You go up again and you hit a new high. And again you're turned away. So you're turned away a third time, a downside reversal, which led to further weakness. And finally, one last attempt at these new highs around the 26 range. And you can just see over 4 weeks, the stock cannot get through 26. It just keeps getting turned away. Finally, you get this stalling action here. You go into new high ground but close well off the highs, mid-range, and then finally the stock reverses and just falls. You fall out of this churning range here and ultimately fail at the 50-day moving average and continue to just move down from that point. So if you see this kind of churning action occur where your stock just isn't going anywhere, I have a saying, I don't like to sit in a stock waiting for something to happen. I would rather scale out of my position as I see is having trouble in this range. And, I could always buy the stock back again if it consolidates and breaks out. But I'd rather scale out and wait and see what happens than just sit in the stock when potentially it can fall apart relatively quickly. So these are the 7 signals we're going to cover today. Now what we are going to do is go through a couple of stock animations. I'm going to bring Mike and Amy back into the discussion. And what we're going to do is go through 2 topping processes on 2 different stocks. And Mike and I will talk about how we would scale out of the position as we see the warning signs. So Mike, you want to take us?
Sure. Let's start with the first one. And just, as you're watching this, just imagine you have a position that you bought out of that double bottom. You probably started purchasing right at the pivot around 31 bucks, and then maybe you pyramided into it a little bit. So pretend your cost basis is, maybe $33, $34, and we're looking for some sell signals. And the concept here is to not sell everything on one day unless you're forced to with the massive gap down, but we're going to be looking for sell signals and try to scale out. And let's just imagine that you have 1,000 shares, and let's walk through this and see when we'd be selling those shares.
All right. Okay, so the first signal we see here, and we're going to identify each of the warning signs that we're going to come across, is a day in which the stock goes into new high ground. You don't really have a heavy volume here, and you're closing well off the highs. So this is characteristic of stalling action. You can even say it's going into new high ground on low volume. So it's almost, it counts as 2 signals in a sense. But we're going to basically identify that as stalling action, again, because of the weak price action.
All right, so now we're moving up a few more days and we get similar action. So a lot of times with these offensive sell signals, you're not necessarily going to act on the very first one or sometimes not even the second one. but you do want to be nimble and flexible. And, one of the things that Bill's taught us over the years is, sometimes just sell a little bit just to make sure you're not going to freeze up. So sometimes you might, just sell 5 or 10%. So here we have, 2 days of stalling. We have a good gain in that. Remember, our cost basis is, around $33, so we're up $10 on it. So, maybe you sell, 100 shares here, and then we'll look for some more sell signals before we sell some more. You don't want to get crazy and sell everything here.
Right. And Bill has said in the past, it's always preferable to sell when you've got a market to sell into. You don't always want to sell when things get really ugly.
When you have to.
Exactly.
Right.
So, I like personally to sell into strength. So, you see these kind of, weak days moving into new highs. You can sell a little bit into it, as Mike mentioned. Let's continue and see what happens. And the very next day, we get another day where we are, basically at new highs. Now look at the volume this time. Volume is above average. Now it's not super heavy. It's only 13% above average, but it is above average. You are kind of, running in place here. So that would be identified as churning action. So you can, basically what's happening is your stock is coming under some distribution. Let's continue.
All right, so now that at first glance that day does not look too bad, you're trying to go over some, area of, small area of resistance, and it's closing near the highs. So the price action isn't bad, but if you, go down to that volume area, you can see that there's really no volume there to speak of. So that's new highs on low volume. That's your forced sell signal. So you want to ask yourself, how many shares would you have sold by now? And, maybe you sold, 20-30% of your position by now. About how much would you have sold, Chuck?
Yeah, I agree, Mike. Maybe if we started with 1,000 shares, maybe I've sold 250 shares or so, And the beauty is the stock is at new highs. I mean, you're within 1% or so, or even closer to your, to the peak of the stock. So, we haven't, we're taking advantage of the strength, basically, to scale out. Let's see what happens. There was your new highs on low volume. All right, so the stock 2 days later again goes into new high ground here and closes in a weak fashion. So again, you see a pickup in volume. It's not super heavy, but it's above average. You go into new high ground, close well off the high. So again, the stock really hasn't gone anywhere over the past week, right? So this is a churning day here, churning action. And again, we've had 5 sell signals. And again, the stock is basically within 1% or 2 of its highs. Let's continue.
All right, so now we get into new high ground and we get turned away and we close at the low. So that was a downside reversal that Charles was talking about earlier. So it's in, now we have 6 reasons to sell. So some of you might be looking at this and saying, you know what, maybe you hadn't sold any yet, but once you get 6 sell signals, you need to do something. And so again, just ask yourself, how many shares would you have sold? And I'd probably, still just be around 30% or so. I tend to, not do as good of a job as Charles does as selling into strength. So, how much would you have sold by now?
I mean, maybe by this point, I'd be with you, maybe, 30 to 35% of my position. I mean, again, the stock hasn't shown really any weakness. It's really just more kind of offensive selling, some distribution here. The stock hasn't even had a pullback to the 50-day yet. So oftentimes the big winner will at least have one pullback to the 50 days. So, when you see this kind of action, this downside reversal, the expectation is that it's going to come in at that point. So, an obvious area for it to come into would be the 50-day moving average down here around 40. So you have to ask yourself, are you prepared to see your stock, fall, what is that, 6 points or so? So that would be about 15 or so, 16% off its highs, because that can happen at any time, and it would still be normal for the stock in the context of the uptrend. So let's see what happens.
That's freaking ugly. So, lots of times we end up in a situation like this where, maybe you haven't done any selling yet, and then you get hit with a huge day like this. What I would suggest in a case like that is I'd like to kind of slow down before I take action, print off the chart, and kind of mark up the different sell signals that were there. And so, I've been in this situation before, and so you mark them up, and before you know it, you realize you had 7 sell signals, and maybe you didn't do anything. So on this day, that stock is not acting right. It has its largest one-day point loss. So if you haven't sold any, you're going to sell a lot. If you've already sold some, you're in a little bit of a better position. And then you just have to ask yourself, is this a stock that you want to sit through a base on or not? And that really becomes more of a fundamental question. But here the stock is not acting right and needs to put in some time. So I would at least have sold more than half my position. So I'd probably be down to about 30% of my original position by the end of this day. What about you?
Yeah, Charles, how much are you in right now?
Yeah, so I mean, I guess I'm not as convinced that it's going to now form a base. The stock is still held at the 50-day moving average. It closed well off the lows here. It can certainly come in and hold the 50-day. I will usually not completely exit a stock until it breaks the 50-day moving average. I mean, that's your uptrend line. I showed you previously on that travel zoo that, sometimes that can be an incredible indicator to keep you in a really huge winner. Mm-hmm. But it doesn't always work, so there's no guarantees.
So how much would you have pulled
So
up?
I would say I probably still have 50% of my position, but keep in mind, and this is one of the things that Mike and I talk about during the workshops, our different styles of trading. I like to sell into strength. So, I mean, I've probably realistically already sold, a fair amount on the way up, So if I got out at 30 or 40% of my position on the way up, I don't need to act too drastically here on this bad day. I would probably, sell some, but wait and see if it can hold at the 50-day moving average. And if it starts to act well around the 50-day, I might actually even add to my position. But it's anyone's guess. We'll have to wait and see what happens. Mm-hmm. So let's see what happens. Okay, so it didn't work this time. This is your first decisive break below your 50-day moving average. Now, I mentioned that most big winners will at least have one test, or successful test of the 50-day moving average. It doesn't always happen like that. So in a case like this, I might lose a little more than I would have, wanted to, but I gave the stock as much room as I'd want on this decisive break. Again, look at the volume too. You've got heavy volume on that really bad day Mike talked about here, and then 2 more heavier days of down volume. So I would probably sell my, almost all my position at this point, unless I had really high conviction and maybe wanted to see if it can come back, and shoot back up. But it's not a good close. So.
Yeah, that's terrible action. And, Charles and I have been studying, how big winning stocks handle themselves around the 50-day. And as he said, if you want to really hold a move, for the bulk of a massive move, just waiting for that 50-day to be broken in a decisive fashion is, your best tool to use. So, in cases like that, if you have a huge price objection, price target, you might not have sold any until this point. So it really depends on the stock and how you want to treat it. With this type of action, if this was an average stock, I'd be out of the position, whatever I still had. So I'd be in cash as it pertains to this stock. Let's see what happens.
So looks like you got support here for one day. You had this, what we call an upside reversal. and our expectation would be that you would continue to move up from that point. But instead of moving up, we get what we call a down. Not only is it a downside reversal, but it's also an outside day closing down, where your high and your low is both higher and lower than the previous day. And when you, they say that, you know, the direction in which you close is the direction in which the stock will continue to move. So this is really bad action here, given that your expectation was that it would move back up, and it didn't. So if you decided to, let's just say, you know, I still had 20% of my position, and I, you know, held through this upside reversal here, the fact that it closed like this on this day, I would be completely out of the position for sure.
Yeah, I completely agree. That's the worst day on that chart, and if you don't see how bad that is, you know, take some time and study this one for a while, because, you know, as Charles mentioned, it really is an expectation breaker, and now that chart is pretty much broken because your expectation is, you know, it's going to just go down, and you never know how low it could go. It could just form a base, or this could be the ultimate peak, but it's just guesswork at that point. So that's an expectation breaker is a big deal, and you need to be out of that stock unless you're really trying to hold through a base.
All right, so let's see what happens. And it continues to move down from that point. And this is fast forward to a weekly. This is, you know, this is the top. This is your double bottom. This is your move up. And these are where all those sell signals were occurring up near the peak here and just on the way down. So you can see that, you know, even when I broke the 50-day, when you're off, what, 13% or so off the peak, look how much lower it went. You know, it really got into trouble. So again, it's really important to take advantage of these warning signs and not just recognize them, but act on them, take action, scale out, and you know, move on.
And look at another thing here is you have 16 out of 17 weeks up out of that double bottom base. And so you're moving up. It's just a gorgeous, tight move up, and that real change in personality, that, as you said, that break of the 50s, it just looks completely different.
Yeah, I agree, Amy, and it's actually surprising. You wouldn't think that the stock would kind of peak like that, but you can't question the chart. I mean, the chart is telling you all you need to know. So, so why don't we move on to one other example of an animation. We're going to go through it day by day, and we'll see what we see in this chart.
Yeah, so here another double bottom, and this one you can just tell by the character of how it trades. It's more erratic. It's going to be a harder stock to handle, most likely, based on the character of what we've seen so far. But we're going to imagine that we purchased that out of that double bottom there, right around $90, and we probably haven't pyramided much into it. Maybe our cost basis is about $91, $92. And so again, just pretend for this you know, example that you have 1,000 shares, and you're just going to decide, you know, when you're going to sell those shares.
Okay, so the stock is kind of moving up out of this little area of you know, this little consolidation here. You might even be adding. Would you be maybe adding, Mike?
Yeah, maybe, you know, it's a little sloppy, but yeah, I like to add on strength. The volume's not wonderful, but might be.
So here, and the volume came in here. So we might be adding to our position here. This is a proper secondary buy point where you can pyramid into your position, but you wouldn't get too crazy. You know, maybe, you know, Mike mentioned it's quite a volatile stock. It's not doesn't move in a nice, predictable way. So, you know, maybe you add 10% or so to your position.
Yeah, I agree.
All right, so let's see what happens. So,
go ahead.
Okay, so, you know, our first sell signal, this is a downside reversal. There's really no volume to speak of here, but again, I talked about the downside reversal in the context of the price action. So our expectation is that the stock is going to come down at least for several days. Let's see what happens. That's your downside reversal. Let's continue.
All right, so it comes down just a little bit, and then you go into new high ground, and you have some stalling action. Look at where you close. Well, you know, pretty much at the lows for the day, and not really enough reason for me to sell, just because the stock doesn't act very well. So it's not out of character at this point. So, you know, any of the shares that I just bought, yeah, I'm still going to hold on to those. What about you?
Yeah, I mean, it looks like the stock is having trouble here around 110 or so. So I'm a little weary of it, but you know, right now I'm just monitoring the stock. Maybe I sold this a little bit. Let's see what happens. So it does go into new high ground, and again shows some stalling action here at new highs. So you know, it's just not great action. There's no heavy volume to speak of, but we're just taking note that you know, generally when you're moving into new high ground, the stock closes in the upper quartile perhaps of the range. That would look a little better than the fact that it keeps getting turned away. So what does that mean? It means that there are sellers at these levels driving the stock back down. So let's continue.
And wow, what a crazy, crazy day. There's a lot to learn from on this day. Now, first, you kind of want to, you know, ask yourself in the morning when that stock is probably gapped down at that 50-day, you know, what are you going to do? You know, I used to, you know, act a lot in the mornings, but you know, I learned a lot from Charles, and he tends to wait for the end of the day to get, you know, that extra bit of data where you're closing for the day, which really means, you know, has a significant meaning. So this stock, by the end of the day, it closes, you know, pretty much at the highs for the day, which is showing, you know, a lot of supporting type of action. But you also, to get the most out of going through an animation, is you want to be realistic. And as bad as that stock gap down and the type of action that this stock has been giving you for the last, you know, year, I know I would have, you know, exited probably the full position, or maybe at least most of the position, because you know that broke your expectations. Massive volume, you know, 4 million shares, you know, the largest amount of volume, you know, on the entire chart, and it's a, you know, huge down day with the gap. How would you handle that, Chuck?
Yeah, I mean, I agree with everything you're saying. I think that there's mixed signals here. It is your largest daily point drop, and it occurred. There was a gap down, and the volume is huge. I mean, the heaviest volume on the chart. But it also did close well off the lows. It got support exactly where it should have at your 50-day moving average. So, you know, I remember one of the traders that we trade through here, you know, once had, didn't know what to do. You know, I didn't know whether to buy or sell. He says, well, why don't you split the difference and sell half your position? And sometimes that's actually great advice, because it is showing you mixed signals, so maybe you sell half and hope for the best.
All right, so, for the sake of this example, I'm just going to pretend like I'm holding about 300 shares at this point. About how much would you?
So let's say I sold half my position. Yeah. So let's see what happens.
Well, it's settling down, which is nice. Trying to get some support at the 50-day, bouncing a little bit.
This action here, by the way, is your shakeout below your 50 days. So you had really two shakeouts below your 50-day, which is constructive because that shakes out the weak holders of the stock. And then you gap up. Look, you gap up. You've got heavy volume up 186%. But what do you think of the way we closed there, Mike?
Yeah, I wouldn't be happy with that. There's a couple ways to look at it. When you have a gap, you can, you know, really kind of trace all the way down and pretend like, you know, there was a full bar on there over the, you know, the space on there. And with that in mind, you know, for that full range, the close doesn't look as bad. But the reality is, for the bar that we have, you know, we're closing in the lower half of that after getting turned away at new highs. So, you know, I probably wouldn't be selling there, but, you know, I wouldn't be too happy, you know, about that close. Any of the shares that I sat through, you know, the back and forth for the last few weeks, I'm probably going to just wait and see what happens, but I'm not thrilled. What do you think?
Yeah, I agree with you. And the thing is, it got turned away right at the previous highs. So that's the thing that bothers me the most, is that it did clear some resistance down here, but it went into what you might want to consider some supply, and it didn't act well around that overhead supply. So, you all in all, I would say it's more stalling than anything else. So, I'm not crazy about the action. Let's take a look and see what happens. So the next day, you get more stalling action, or even churning because volume was above average at these high levels. So, ordinarily when a stock breaks out, you want to see the stock make some progress and close in a strong fashion. And that's not what's happening here. Let's continue.
All right, so now we get a downside reversal. It's not a major one, not a lot of volume, but as Charles mentioned, volume really isn't critical with a downside reversal, but we're going to expect the stock to come in. So it's given us some time to make some decisions. So at home, you want to, really be thinking, the original 1,000 shares plus a little bit that you added, how much do you still have? Some of you might have your full position. Some of you might be completely out of it, but at least, jot down, where you think you'd be at this point.
All right, so let's see what happens here. All right, the stock pulled back for a few days. It's kind of what you'd expect after a downside reversal. You find more support at your 50-day moving average, and looks like you go into new high ground here. So I don't know, that might look pretty good. Mike, what do you think?
Yeah, I mean, the price action there is clearing an area of resistance, which is typically, where we would be adding. But, that volume, I'm not, thrilled about it. It is higher than the last, week, but, relative to what we've been seeing, it's certainly on the weak side of things. And, I wouldn't necessarily be selling, but I don't think I'd be adding to it at this point.
So let's take a look at what Mike was talking about. So we marked this as new highs on low volume. And again, it was slightly above average. But let's look at it in the context of how the stock moved into new high ground on earlier occasions during the move. And you can see on all these previous 4 occasions, you saw really heavy volume each time. And that's what you want to see when a stock is clearing resistance.
Love to see that.
Yeah, you want to see that kind of action. Now, on this last one here, you had stalling action, so it wasn't really a big positive because of the way the stock closed. But you want to see heavy volume on this day here, and you're really not getting it. Plus 6% isn't what you want to see at that point. So, you want to take note of that. See what happens.
All right, so now we get another downside reversal. So it's kind of what we were expecting because, as Charles was talking about the volume there, we didn't have high hopes for this. So if you've printed off the chart and you've marked up all these sell signals, you've got, you're staring at 9 sell signals plus some, poor action. So, you really want to ask yourself, do you want to sit with a position here? If so, how much? How much would you be holding at this point?
I mean, if I held half my position through that first, scary day here, I might still have, 30 or 40% of my position here because I'm really hoping that the stock is going to continue to move up given that it kept finding support. But you can't deny the fact that it just seems to be getting heavy. And it just seems to be, let's just look at it over the prior, 7 or 8 weeks, it hasn't really gone anywhere, right? It was up here around, 118 or so, and it's still around 118 or 116. So, maybe I have 30% of my position, but I'm a willing seller here. I mean, I'm getting bored.
Yeah, I agree. I mean, it hasn't, given us enough to really completely be out of it, since I gap down. But yeah, I'd probably have about, 20, 30% as well.
So let's see what happens here. All right, well.
That's enough.
That one, we don't like that one.
No, so finally you get your decisive, massive break below your 50-day moving average on gigantic volume up 500%. So, nothing else to say about this one. I mean, if you had any shares, you would absolutely be selling on that day. You would be done with the position. and that's the stock is peaked, is topped at this point, and if we carry it out a little bit, it just kept getting weaker here, and I think we all know what eventually happened to lumber liquidators. That's what happened. So the top we were talking about was all around here, around 100, between 100 and 120. Well, now it's went down to about $12. So you never know what can happen to a stock. I mean, I don't think anyone envisioned that a former leader would fall that that badly, but all stocks are dangerous, as Bill would say, unless they're going up. So you had your technical indicators, you'd scale out of your position, and you wouldn't really revisit it unless it gave you a reason to get back in.
I agree. That's why we don't hold stocks long term.
And this one had already made a massive move. You look at the price, $13.43 over there, and it had made a quite a move before it really did start correcting severely.
It was a huge winner. It was a huge winner. It was a stock that we were trading.
Yeah.
And it was great while it lasted.
Sure.
But every stock has their time, and when it's over, Mike mentioned we don't hold stocks long term unless they're acting right. And this one, wasn't acting right toward the end of the move, and it never really gave you another chance to want to own it.
I have a question here, and it seems like this one would be a good one for you to answer now. When do I use the daily versus the weekly? For instance, in this particular situation, if someone was looking at the weekly, could they just use that first break of the 10-week?
Right over here.
Well, it's a great question, and I think that really depends on your style of trading, and some people are a little bit on the slower side, which can really make you a ton of money. And if so, if you don't like doing a lot, taking a lot of action, sitting back and looking at the weekly and just waiting for that stock to decisively break your 50-day, probably going to make more money than anybody. But we enjoy trading. We like looking at both of them, and you can see here where we were able to, we were still in it at the end, but we'd have a much smaller position.
Yeah, I think it's important really to use both the daily and the weekly chart. I mean, they're going to give you different views, and they're going to give you different information. And most of these sell signals that we talk about in our workshops and even today are things you're going to see on a daily chart. So if you're only focusing on the weekly, then Amy, as you mentioned, you would probably hold it until you saw that decisive close below the 10-week. And that can work great if you have the right stock.
Right.
But not all stocks
are
hold
that easy,
it.
right?
Yeah, it looks a lot easier than it really is.
Do we have any other questions coming through?
I just want to mention to everyone that we do have a special slide today, and we want to tell you we have an offer. You can take 3 months of IBD or the eIBD for only $30. So if you have not tried IBD, now would be a good time to do that.
Do you have any more questions coming through?
We do have a few more questions here. I want to see. Here we have one. What about fundamentals and earnings?
Earnings. Earnings, that's the most difficult thing, right? If you step back and look at a chart that has earnings plotted on them, given enough time, a stock is going to follow the earnings. If the earnings are going up, the stock is going to go up. If the earnings are going sideways, it's going to go sideways, and obviously if they're going down, it's going to follow it. So that is a tricky thing. It's one of the things, if you're following Cancelim, you have to have the earnings there. But as you go into earnings season, that becomes very, very tricky. And how do you handle earnings?
Yeah, I mean, as I mentioned, when it comes to selling, and again, this webinar is focused on selling, we're going to focus on the technicals and not necessarily wait for the earnings to get bad before we begin selling. But as Mike mentioned, managing your portfolio around earnings season can be very complicated. You have to basically face the fact that anything can happen going into an earnings release. Your stock can report great earnings, and it can still gap down 20%. for, maybe they say something on the conference call. So you need to be willing to take that kind of risk into earnings season. I don't believe there's any way to game earnings. I've never figured out a way to do it. So, there's a lot of considerations. I don't have time to go over all of them now, but what I would say is the way I personally treat earnings season these days is I do cut back on my positions. I don't want to take a great amount of risk in any one position going into earnings because, most of the time I'm not willing to pay, suffer the consequences if it goes against me.
Yeah, and I think you can, like you said, that you can assume that any stock, no matter how good it is, can fall 20%, sometimes more on earnings, and just position your account accordingly going into it. Because it's a roll of the dice these days.
It's roulette.
Yeah.
Yeah, it is. Do either one of you use stop loss or stop limit orders?
I used to use stop loss orders. Now with the flash crash and then what we just had a couple months back, that's the downside to them. Now a lot of people listening probably have day jobs and they can't watch it. It's tough to have a stop with a limit because it might just go right outside your limit and you think you have this protection but you don't. But then, with what we just saw with the flash crash, you got to rethink that. I think it's best to find a product that has alerts and have it, let you know so you can look at it and see, is it just one of these crazy openings for 5 minutes or is it for real?
So what is the difference? I have the question here is, what is the difference between churning and a flat base?
That's a really, really good question, and that's a very difficult question to answer because they can look the same. Again, churning is going to be heavy volume without further upside price progress. Normally, if you're having a flat base form, you're not going to see super heavy volume throughout that period. Now, you may. So the thing is, you never know what's going to actually happen, which is why I said don't sit around waiting for something to happen. There's a proper pivot point when you have a flat base. You buy it as it's breaking out. So because it's so difficult to differentiate between healthy basing and churning, because there have been times where I've seen stocks go sideways on relatively light volume, and they still fell after that. So, when we study bases, we study them after the fact. There's no guarantee that a cup with handle is going to break out. When we study our model stocks, there are stocks that made big moves. We know it because it happened. So, volume is one way you would differentiate them, but
and the price action on the example that you were going over where you showed the churning, it kept on hitting lower lows. It was almost like it was a triple bottom within that area. And that in itself, if you were interpreting that base, it looked faulty. Typically a flat base is going to come down. It's going to hit an area where it's not going to go lower, right? And that's going to be the bottom of your base. And it's going to go back up and come back down and maybe hit that level, maybe have a little shakeout. But that one, it was wedging in an odd way where it just kept on going lower lows, but the peaks were the same. And so I was studying that, and I thought it looked like a weak base, and I think that was a very good question that they asked.
Very good question. All right, do these sell rules apply to ETFs?
With ETFs, the only time I really use them is hedging and shorting. So I don't know what to say about that.
Yeah, I don't trade ETFs myself. So at least not in any size or very often. So I haven't used them in the context of ETFs.
Is stalling how bad is stalling as an indicator if the market's also moving down?
Well, lots of times the stock is going to follow what the market's doing. So you want to see, look at the relative strength line. How is it acting with what the market's doing, and is it abnormal? But, lots of these moves are just going to be whatever the market's doing. They're just magnified a little bit.
Yeah, I agree. I mean, the market action is, the M and Can slim is a huge factor in how stocks behave, and a really, when the market's off 300 points, 80% of stocks are down. Yeah. So, it's just how it works.
All right, so again, we just want to tell you we have this offer of 3 months of IBD or the eIBD for only $30, and you can go to www.investors.com/3 for 30 if you would like to take advantage of that. Well, I want to thank our wonderful presenters. I hope that you realize you got like a major treat from these guys. You know, the chart schools and the level 4s, these are really expensive workshops. Mike and Charles were fabulous to give us their time. They were so wonderful. High five to both of you. Anyway, just thank you very, very much for doing this.
Oh,
Thank
this
you.
was
Very welcome.
this was fun.
Yeah, it was great.
So you guys did a great job. We really appreciate it. All right, and thanks to all of you for tuning in today, and we will probably see you back here in a couple months.